and gentlemen, good day and welcome to the Avalon Technologies Limited Q2FY26 conference call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. I now hand the conference over to Mr. Deepak Agarwal from Axis Capital. Thank you, and over to you, sir.
Thank you, Huda. Good afternoon, everyone, and a warm welcome to the Q2FY26 earnings phone call of Avalon Technologies. To take us through the results today, we have with us from the managers, Mr. Kunamit Vichcha, Chairman and Managing Director, Mr. Bhaskar Srinivasan, President, Mr. Suresh VR, Chief Financial Officer, Mr. Sriram Vijay Raghavan, Chief Operating Officer, and Mr. Venki Venkatesh, Chief Sales Officer. Mr. Vichcha will give us an overview of the business performance and will be followed up by Mr. Suresh's remark on the financial performance, post which will open the floor for Q&A. As we move forward, it is important to bear in mind that any forward-looking statements made during this call are subject to potential risks and uncertainties, both known and unknown. Now, without any further delay, I'll hand over the floor to Mr. Vichcha for his initial remarks, the CMD. Thank you, and over to you, sir.
Thank you, Deepak. Ladies and gentlemen, on behalf of Avalon Technologies, we extend a very warm welcome to our Q2 FY26 earnings call. I would like to begin by expressing our sincere gratitude to our investors for their continued trust and confidence in Avalon. Our growth journey would not have been possible without your steadfast support. Over the past few quarters, we have delivered consistent sequential growth, with every quarter building upon the previous one and meeting or exceeding our guidance. This steady upward trajectory reflects the strength of our diversified business model and a disciplined approach to execution. Our growth continues to be broad-based across verticals, geographies, and capabilities. During H1 FY26, the India business grew 44% and the US business grew 52%. Our diversified customer profile is consistently supporting our growth. This consistency, even in an evolving macro environment, underlines Avalon's ability to deliver sustainable and profitable growth while maintaining financial prudence. Building on this foundation, profitability has improved, further strengthening ROCE and asset turns, supported by an expanding order book. On the topic of tariffs, which has been widely discussed across the industry, we would like to clarify that it is not limited to a simple 2 or 3 rate structure. We have effectively paid 50 unique tariff rates during the last 6 months. Our long-standing presence in the US, deep understanding of the geography, and strong customer relationships have helped us maintain tariff recoveries of over 99% from our customers, underscoring the trust and partnership we share with them. With well-diversified growth, continued demand visibility, and traction from our new programs, we remain confident in the outlook of our business. Accordingly, we are revising our full-year revenue growth guidance upwards to 28 to 30% from the earlier 23 to 25%. Let me now move to the key financial highlights of the first half of FY26. As of September 30, 2025, our order book stood at rupees 1,863 crore with an average execution period of 14 months, reflecting a 25.4% year-on-year increase. In addition, long-term contracts with executional timelines of 15 to 36 months stood at rupees 1,168 crore. This growth has been well-balanced and diversified across industry verticals and geographies. For H1 FY26, revenue stood at rupees 706 crore, representing a 48.7% growth over the same period last year. Our core expertise in box build and system integration solutions continues to strengthen, now accounting for 53% of our total revenue. EBITDA for H1 FY26 is at 68 crore, reflecting an increase of 98.5%. and PAT is at 39 crore, an increase of 158.3%. ROCE improved to 18.4% from 8.2% a year ago, while asset turns remained healthy 8.7 times, indicating continued efficiency in capital utilization. Net working capital is at 131 days as of September 2025, compared with 124 days as of March 2025, mainly due to temporary elevated inventory levels to support upcoming production and growth. On a sequential Q1 to Q2 basis, net working capital improved by 11 days, driven by a 7-day improvement in receivables, 3-day improvement in inventory, and a 1-day improvement in payables. We remain focused on improving working capital efficiency and expect to bring it within 120 to 130 days in the next few quarters. Gross margin stood at 34.9% for H1 FY24, which remains at the higher end of our guided range of 33 to 35%. For Q2 FY26, gross margin was at 34.3%. India manufacturing operations, which continue to serve both domestic and global customers, accounted for 81% of the total revenue in Q2 FY26, delivering a healthy profitability with an EBITDA margin of 14.1% and a PAT margin of 10.9%. Revenue from our U.S. manufacturing operations contributed to the remaining 19%. The U.S. operations scale up further. We expect operating leverage to support margin improvements in the later part of the year. Avalon's dual presence in U.S. and India offers a unique advantage. Our U.S. facility helps customers localize production and manage tariff exposure, while our India operations offer a cost-effective and scalable manufacturing base. This geographic flexibility positions Avalon well to support customers and adapt to changing trade dynamics. As tariff-related discussions in U.S. and India continue, we are monitoring developments closely and will stay agile and measure in any strategic adjustments. We are also seeing increasing engagement from customers in multiple geographies for Made in India products, and will share more updates in the coming quarters. Now moving on to our key growth drivers and an update on major programs. We remain encouraged by the continued momentum across our three growth engines. 1. Existing business. This is driven by long product life cycles, mission-critical products, and steady recurring revenues. The energy storage system program is progressing well with production ramp-up underway as planned. In the aerospace vertical, cabin sub-assemblies are currently under first article inspection and progressing in line with our plan for ramp-up in the first half of the next calendar year. Despite India having the largest spending aircraft order book in the world, local manufacturing content is relatively small but is growing rapidly. Our aerospace business is benefiting from this shift. H1 FY26 revenue grew 59% over H1 FY25. 2. New business wins. This is built on sustained effort over the past few years, with these programs now translating into fresh orders and production ramps across multiple verticals. Our dual show model and the new Chennai export facility have supported this scale-up. Production for locomotive engine subsystems will begin in the second half of this year. Our railway business continues to gain momentum with new customer additions and expanded product lines. Notably, H1 FY26 rail revenue grew 58% over the same period last year. At the same time, we are making steady progress in advanced technology segment. As mentioned last quarter, our partnership with a leading global semiconductor company for box build manufacturing is progressing well, with the volume ramp-up expected in FY27. Meanwhile, the railway govt system has completed testing and is on track for commercial production in the second part of next year. These programs strengthen our market position and extend our reach. 3. Opportunities pipeline. We continue to see a diverse and expanding set of opportunities progressing towards finalization. With encouraging potential, in both size and scope. During the quarter, we onboarded 3 large US-based customers across industrial and defense verticals. We will share more details over the next few quarters as these programs progress from prototyping to production. Manufacturing will initially commence in the US, followed by a transition to India, leveraging our dual presence advantage. With all 3 growth engines at different stages, we have continued to front-load investments in capabilities, manpower, inventory to stay ahead of the expected growth. On the infrastructure front, our export-focused Chennai plant has commenced production and is ramping up steadily. To meet rising domestic demand, we are progressing well to complete phase 2 of our brownfield expansion in Chennai by the end of Q2FY26. These investments are aimed at ensuring readiness for next phase of our growth, and we remain confident that operating leverage will begin to take effect in the later part of the year. Avalon stands on a strong foundation to capitalize on vast potential emerging across our end markets. With a healthy order book, expanding capabilities, and a culture rooted in operational discipline, we are well positioned to deliver the sustained growth and long-term value for our shareholders. To summarize, Avalon has started FY26 on a strong note with a broad-based revenue growth, a large order book, improved operational metrics, and a healthy capital efficiency. Our diversified business model, dual shore presence, and expanding customer base provide both visibility and resilience. We are ramping up new projects across multiple industries, and our entry into the semiconductor equipment space marks a key step towards a high-potential advanced technology segment. With a stronger growth outlook and disciplined execution, Avalon is well positioned to sustain its momentum and remain focused on building long-term profitable growth rather than short-term gains. With this, I will hand over to our CFO, Suresh Veerappan, for a detailed overview of our financial performance.
Thank you, KB, and good afternoon, everyone. Thank you for joining the call today. During Q2 FY26, our revenues were rupees 382 crores, reflecting a 39% year-over-year increase from rupees 275 crores in Q2 FY25, and an 18% sequential growth from rupees 323 crores in Q1 FY26. For the first half of FY26, revenues stood at rupees 706 crores compared to 474 crores in H1 FY25, representing a year-on-year growth of 49%. The growth was well diversified across verticals, geographies, and customers, driven by steady execution and strong traction in both our India and US operations. It also marks our 5th consecutive quarter of sequentially good performance, underscoring the consistency of execution across business segments. Over the past few quarters, our growth has remained broad-based and disciplined, supported by customer diversification and focused operational delivery. This sustained momentum, together with stronger demand visibility and a healthy order pipeline, positions us to raise our FY26 revenue growth guidance to 28 to 30% from the earlier range of 23 to 25%. Gross margin of Q2 FY26 was rupees 131 crores, representing a margin of 34.3%. For the first half of FY26, gross margin stood at rupees 246 crores with a margin of 34.9%. Which is at the upper end of our guided range of 33 to 35%. This reflects a year-on-year growth of 47%. EBITDA for Q2 FY26 was rupees 39 crores, a 28% increase from rupees 30 crores in Q2 FY25, at a margin of 10.1%. For the first half of FY26, EBITDA stood at rupees 68 crores, reflecting a year-on-year growth of 98.5%. PAT for Q2 rose to rupees 25 crores, a 42.9% year-on-year increase from rupees 17 crores in Q2 FY25. We continue to invest in talent, capacity, and inventory to support upcoming growth in new programs. These initiatives strengthen our foundation for long-term growth and are expected to enhance operating efficiency as volumes ramp up in the second half of the year, with this impact being more visible towards the end of FY26 and carrying into FY27. Moving on to the balance sheet, net working capital days improved by 11 days from 142 days in June 2025 to 131 days in September 2025. Net inventory days improved by 3 days from 104 to 101. Trade receivable days improved by 7 days from 87 to 80. Trade payable days improved by 1 day, increasing from 49 to 50. As of September 30, 2025, total outstanding debt stood at rupees 128.92 crores with cash equivalents and investments of rupees 68.36 crores, resulting in a net debt position of rupees 60.56 crores. Capex for Q2 FY26 and H1 FY26 was rupees 14.8 crore and rupees 24.4 crore respectively. With a Capex light model, asset turns remained strong at 8.7x and return on capital employed stood at 18.4%. Our growth approach is built on a balanced mix of steady core revenues, new program ramp-ups, and a healthy pipeline of prospects. While we continue to monitor global geopolitical developments, the structural EMS growth story remains intact and continues to strengthen. With a resilient balance sheet, scalable operations, and strong customer trust, Avalon is well positioned to capture emerging opportunities and deliver sustained long-term value to all stakeholders. To summarize, Q2 reflects continued progress across all operating and financial metrics. Our priorities remain consistent, driving profitable growth, strengthening balance sheet efficiency, and deepening customer partnerships. As we look ahead, we remain focused on sustaining profitable growth through disciplined execution and operational efficiency. Thank you.
Thank you,
Could we
Suresh.
open the floor for Q&A?
Yes, please.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Tanesh from DAM Capital. Please go ahead.
Yeah.
Hello, Tanesh.
Hi, sir. Good afternoon, and congratulations on a good set of
Sir,
numbers.
can you please be a little louder?
Yeah. Am I audible now?
Yes, you are.
Yeah. Good afternoon, sir, and congratulations on a good set of numbers. So my first question is on the U.S. operations, right? So if you could give any sort of update on how the offtake is improving despite the tariff implications, right? I mean, you did mention that 99% has been recovered in terms of tariffs, but going forward, how do we expect the U.S. clients to sort of, accept the tariff implications, and do we expect the manufacturing per se to improve from the current 20% in U.S., which would thereby then sort of have any sort of impact on margins?
That's a good question. So we are seeing a lot of opportunities now with the dual sourcing model we have, where they can start in the U.S. and when the tariffs settle down, the longer term, the larger customers are taking that view. Let us start in the U.S. and transfer to India when the tariff settles down, because it's difficult today for customers to judge what is the tariff rate where, but they always want to come to India, and we are offering, I would say, initial stopover in the U.S. before they transfer, so they have consistency on revenues. And saying that, some of our existing customers who always wanted to make in the U.S. are ramping up, especially our battery storage, energy storage systems customer, which we've been working for the last 4 years. We are seeing a substantial ramp for them, which has already started and into the next 12 months. So we're very positive because we have a solution for customers to come to India, because otherwise it is very difficult for customers to see how can I come to India with a 50% tariff, right? So this dual model helps us a great deal to make that happen.
But with that happening, we don't expect any interim impact on our margins to that extent.
So if we look at our gross margins, we have stood steady. On the margin front, I would say we are investing into the future. As you've seen some of these larger ticket customers cutting in, we have a few more in the next few quarters. So we are getting the team ready, especially in India, to get ready for the ramp.
Understood, sir. And sir, my second question would be on our domestic operations. Obviously, we've seen very strong growth over the last year in the domestic market. So if you could sort of if you could help us understand, any new clients that are sort of ramping up, and under what segments would that be? And potentially, if you could even list down the opportunities for our railway business. You did mention that it grew very sharp at around 57% in the first half. So apart from the coverage opportunities will come in next year, any other product categories which are also scaling up well out there? Yeah, that's it. Thank you.
I'll answer the last part of your question first. The railway opportunity is real and is growing. We're growing, and last year also we grew substantially. This year we are seeing the first half growing not only with our existing customers, new customers, as well as new products from existing customers. Okay. So we will continue to see this growth in the foreseeable future as India expands and as India grows in this segment. Apart from that, the next three large customers which we are kicking off are all India-based, and that gives us its, the timing of it is perfect. So I think our goal is always to be 50-50, 50% exports and 50% India. And today in exports, we have started to see a lot of activity, and the numbers will reflect in the future. Apart from US, the other geographies are slowly kicking in. Did I answer your question, Tanya, or did I miss something?
No, sir, that did help. Just wanted to understand any particular segments in which we're seeing this ramp up for the domestic operations apart from rail.
So it's mostly mobility and industrial.
Understood, sir. Thank you so much. That answers my question.
Hello?
Yes, that answers my question. Thank you.
Thank you, Tanya.
Thank you. The next question is from the line of Samit Sinha from Macquarie. Please go ahead.
Yes, thank you very much. Question regarding gross margins. Sequentially, gross margins decreased despite the fact that the revenues increased nicely. And I think you kind of hinted at it that you're investing into it. But if you can break it down between your India and US operations, seems like India operations, your gross margins improved sequentially, while in the US operations it went down. So can you explain that dynamic? Because I thought for some reason that all the investments were happening in India, but seeing that maybe there's something in the US as well.
You're talking about gross margins. I believe they have not changed much. Our range has always been between 33 and 35%, and we are well within on the higher side of the range. A few quarters we may have 36, okay, or 37 in certain times, but our guidance always been between 33 and 35, and on H1 we are at 34.9, and Q2 we are 34.3. So it could be because of product mix, and there's no change in gross margin guidance here.
Got it. Okay. So that's and in terms of these the new business that you're seeing, kind of a broader question. So these three large customers in India, can you talk about which verticals, which sectors they're coming from, and can you also kind of comment on the average ASP and order size of these new customers? Is it larger, average? Any sort of context would be appreciated.
So I would just say power and industrials are the two key areas, and we will start seeing activity maybe late part of this quarter or next quarter, and substantial. They could be top 10 in our top 10 customers in the end of this year or so. Did I answer your question, Sami?
Yeah, absolutely. Thank you very much.
And just to add, the transition customers coming to US first and then to India. One is in the power sector from Europe, coming to US first and then moving to India. Number two is industrial customer. That's again starting in the US. And third is a defense customer.
Excellent. Thank you.
Thank you.
Thank you, Sumit.
I repeat, you may press star and one to ask a question. The next question is from the line of Praveen Sahai from PL Capital. Please go ahead.
Yeah, thank you for opportunity. Sir, my question is related to the guidance of a 28 to 30% of revenue guidance for this year. That gives me a second half growth to be in the range of around 17 odd %. So why, in the back-to-back quarters in the past, we had seen a very good growth for the last 4 quarters at least. Now you are saying about the lower growth for the second half with your guidance. Why is it so?
No, it's, as you know, probably I'm not sure, we are conservative. So the reasons, there is growth, there's multi-quarter growth. We look at how we look at ourselves and kind of rate ourselves is can we double in 3 years, which we are doing, and then can we further double 3 years from 27. Okay, that's been our motto rather than looking at quarter to quarter. And as you have seen, last 5 quarters, we have delivered more than 40% growth. And we intend to continue, okay? But because of when the projects will cut in, whether it will be in, December of this year or March of next year, so that's the question mark. The business is there, and we intend to exceed and excel with our with the expectations set. Okay. So whatever is happening, we continue to the future.
Okay. Got it. Second question related to the, as you had mentioned about the ramping of your energy storage or battery storage clients in the US. Do we see the contribution of the clean energy in your business to go up from here?
So, as in from year to year, it has grown 34%. Okay. So relative to others are growing a little bit faster because some of our industrial grew year to year grew 73%, communication grew 68%, mobility grew 59%. So related to that, it's a little bit slower, but on a year to year basis, it is growing at a healthy rate of 34%.
The growth is very well diversified across verticals. So I think there is going to be pickup in clean energy also, and we've already started seeing that happening in this quarter.
So we will maintain the contribution at least at what level they are in right now.
Absolutely, and our intention always to have it between 20 and 25. So we are diversified.
Right. And the next question is related to the domestic and the US mix. As you had, answering to the last participant, you said 50-50. You want to be at US and India level business to be. But right now it's skewed towards in the US, around 60% is the US. So do we see a US business growth to outperform in the coming quarter and the year?
Yes, both sides are growing, but we feel that, it's a quarter to quarter thing, 3 or 4 points move. I think last quarter it was 43% India. And this quarter is 40. But intention is to get to 50. I think we should get there sooner than we expect. Okay. We're saying that US is also growing. Okay. When we say US, it's not US manufacturing. Well, we make products for US in India, so we categorize that also. So that 81% includes some of the manufacturing we do for US in India.
Mm-hmm. Okay. Thank you, sir, and all the best.
Thank you, Praveen.
Thank you. The next question is from the line of Vipraw Srivastava from Phillip Capital. Please go ahead.
Hi, sir. Good afternoon. Last year for FY25, our H2 was better than H1. That's why we saw inventory build-up happening in quarter 2. This year, based on the guidance, if we do the back calculation, we'll see H2 more or less being in line with H1. Maybe slight upside. Then why is the case that the inventory days is so high and the cash flow operation is negative?
like what KB had mentioned earlier, some of the new programs are ramping up in Q3 and Q4. So yes, the inventory days as of June 25 was 104, and right now it is 101. But if you look back at March 25, it was 86. But we have to upfront our investments in people and in inventory before a new large program starts in. We expect it to start some of it in Q3, some of it in Q4. What we had given us a guidance on overall net working capital for the end of the year is 120 to 130 days. I think with the way how we are looking forward the ramp up, we are confident of getting to that range of 120 to 130 by the end of the year.
Noted. So, and so for full year, the cash flow from operations will be positive?
Definitely, the increase in revenue can help in operating leverage, creating in more profits from that perspective. That in combination of reduction in net working capital can help in cash flow from operations, but let us wait for the next 1-2 quarters and then we will see from there. Yeah.
Sure.
We have had
on the
cash flow.
Sure.
Yeah, we have had positive cash flow from operations the previous 2 years. The second half did help even in the last 2 years. So, yes.
Lastly, sir, on the operating leverage part, given that based on the current guidance, Q3 and Q4 will be relatively lesser than Q2. So, do you see some margin pressure happening because of operating deleverage in Q3 and Q4?
Let's put it this way. You see the continued growth profile move. Okay, it is when and how it cuts in. Okay, so what you've seen in the last 5 quarters, you will see it going forward. The timing of it, when each program kicks in, is going to be the question, whether it's going to be this quarter or next quarter. It's either going to be December or January, because these delays are not controlled by us, it's controlled by the customer. But we are very confident that we'll continue our growth profile, what we had in the last 5 quarters, as well as the 3-year doubling, which we've committed as when we went IPO, that from 24 to 27 we'll double. I think that holds good even today.
Most of our expenses below the gross margin line are semi-fixed or fixed in nature. And in the past also for us, operating leverage has played out. Right now, like what we have been highlighting the last 6 months and even earlier in the call, we are upfronting some investments in people and inventory right now for the new programs that are kicking up in the second half. So yes, it is on the positive side of operating leverage is what we are also expecting.
Sure. So, and so lastly from my end, in the first half, roughly 81% of manufacturing has happened in India. Based on your presentation, 19% has happened in US. Where do you see this number heading for the remaining 2 quarters? Do you see this heading upwards or remaining static?
So we've always guided to 80-20, and a few quarters there'll be a couple of points up or down either way. But we still for the next 2 quarters we see it's at 80-20.
Noted, sir. And this will have no impact on margins, right? Increased US manufacturing.
I don't believe. I think it will get better as US numbers improve, because our top line is increasing. So with that, the US side also will increase.
Sure, sir. Thank you. Thank you.
You're welcome, Vipra.
Thank you. I repeat, you may press star and 1 to ask a question. The next question is from the line of Chirag from Keynote Capital. Please go ahead.
Yeah, thank you for the opportunity and congratulations for the great set of numbers, sir. So my first question is, post the implication of tariffs, I just wanted to understand one thing, that if someone is buying from our US facility, someone is buying from our Indian facility, what is the cost differential one as a client one is getting?
Okay, that's interesting question. So there's not a flat increase by percentage. It all depends on the labor content. So sometimes even from a $4 per hour in India to $35 per hour in US is cheaper to make in India if you have a 5-hour labor content. Okay, but if you have an automated project, it may not be as simple as that. So it varies by project and complexity. Some of the products we have 200, 300 hours of labor in each part since we make complex parts. So it's difficult to move back and forth. And these are, $50, $60 billion companies. They're not going to change because like the textile industry or the leather industry, because something is cheaper, something is higher. Because you've got 25% tariffs average across any country you go to, okay, in the cost-effective countries. So it's not change we see like the consumer industry where it moves very quickly. You've seen it on numbers. Customers who make in India continue to make in India. And these products have a 10 to 15-year life cycle. So just because of a 2 or 3 quarter change, they're not going to make the switch. And it takes a year and a half for them to make a switch, even if they decide something. So they rather wait it out and pay the, as you see, most of our customers are paid on the tariffs.
Fair enough, sir. So I just wanted to clarification on one thing. Our earlier strategy was similar to what we are thinking right now, where initial manufacturing for U.S. clients were done in U.S. and to showcase them some benefits of shifting it to the India facility where everything what we used to manufacture in US is similar that we were able to do in India. We were able to shift certain clients from US to India, which benefited Avalon from a perspective that labor cost in India was comparatively cheaper than US, led to a significant margin improvement on EBITDA levels. So, would it be correct for me to understand when we are getting new orders or certain clients related to battery electricity storage are initially focusing on US, would be expecting to move to India when they are showcase the kind of quality of product we can deliver?
So you are right and wrong in that notion. So if you look at us 3-4 years back, we started in US, then brought it India sometime. But around a year and a half back, if I recall the timing right, we started bringing customers directly to India. Okay, so to kind of cost effectively reduce our overhead in the US. So that was starting to work, and it was working till this tariff situation came. So we are back to the old model where, okay, let's start building there at a higher cost. And then when it moves to India, of course, we have to deal with the labor piece. So the customers are looking at it on the longer term perspective. Okay, if you are going to tell a customer today, new customer, saying that I'll come to India, I'll make it cheaper, faster, better, but you got to pay 50% tariffs. That's not going to work. So what we're saying is, let's start in the US, and then in 6 months, these are substantially large customers. You have an opportunity to move to India, and you will not waste the time in transferring the technology. So that is what is working in our favor today, having the two-plant strategy in 2 countries.
Fair enough, sir. Means this problematic situation is actually helping us to garner more clients compared to the peers who are actually working in India.
Absolutely. As I said, we have seen more activity now than before.
Right. Sir, over the last 2-3 years time frame, where our revenue used to be around 220 crores annually, we have done a phenomenal job to almost shift it to 400 crores roughly rate. One thing I wanted to actually understand, the earlier order inflow rate on a monthly basis in last 5 to 7 quarters used to be in the range of 130 odd crores on monthly levels and about 1600 to 1700, about 1500 to 1600 crores on a quarterly level, on an annualized level. But today also I'm able to see that on a quarterly basis, our order inflow run rate is still around 460, 470, which is monthly about 150 crores roughly. And our revenue has jumped from 200 crores to 400 crores. So I'm able to, is there any hindrance that you are facing to garner more orders, or is there any supply capacity constraint that we have today, which is expected to unlock, and we are expecting that order book inflow on a quarterly basis is expected to jump from current levels to 550, 600 crores on a quarter basis?
So the way you need to look at it is, see what comes as physical orders and not contracts is 1863 crores for the next 14 months. Okay, I've got another set of orders and contracts, which is from 14 months to 36 months. So the total is around 3,031 crores. And we've got orders past the 3 years, some contracts are for 15 years. Okay, those we don't count. We don't, we're just looking at the near term. So if you're just chasing the order book, what can we ship in the next 12 months is what we look at. Okay. So we are not taking our usual contracts anywhere from 5 years to, some cases 15 years in the aero industry. But we're not counting the last part of it. Did I answer your question, Chirag?
Got it. So just to clarify one, the long-term contracts, which is more than 14 months to 3 years, are separate set of numbers compared to the 1,800, 1,900 crore order book that we have today.
Absolutely, yeah. So we have 3,000 plus and we got more after that.
Got it. Fair enough, sir. That is it from my side. And so one thing, I'm so sorry.
Sorry to interrupt, sir, but I request you to rejoin the queue for follow-up question.
Sure, no issues. Thank you.
Thank you, sir.
The next question is from the line of Neev Mehta from Equirius Securities. Please go ahead.
Hi, sir. Thank you for the opportunity and congratulations for a future of numbers.
Sir, can you please...
We can't hear you.
Mr. Mehta?
Sir, am I audible, sir?
No, a lot better now.
Sir. Please, can you speak a little louder?
Yeah. Sir, so my question was on the side. What is the proposal of order book?
We still can't hear you, Mr. Mehta.
Hello.
Yeah, a lot better. Go ahead, Neil.
Yeah. Really sorry for the inconvenience, sir. Sir, I just wanted to ask,
it drops off after the first few words. It kind of drops off, Neil.
We can't hear you properly, Mr. Mehta. I request you to rejoin the queue. The next question is from the line of Debashish from Swan Investments. Please go ahead.
Hi, good evening. Thank you so much for the opportunity and congrats on a consistent delivery. So I have 2-3 questions. First one is linked to the US operation. If we see the US revenue growth this time has come significantly better, but it has not percolated into the EBITDA margin because my understanding is a large part of the cost is fixed and with utilization improvement, the EBITDA of the US operation should improve, but that is not visible in this quarter at least. So is it more transient in nature and going forward we will see the US manufacturing facility to improve with the, contribute more in the margins? So just wanted to get some sense here.
Hi, Debashish, Suresh here.
Hi,
you're absolutely right in the US manufacturing operations revenue going up because we have been talking about the energy storage system program ramping up, which is what is happening now. That is one of the reasons why the revenue is also starting there. In terms of EBITDA, percolation to EBITDA, a year ago, if you had looked at it, the EBITDA would have been negative 13 crores. But right now, that's not the case, where the operating leverage with increasing and increased revenue over there is helping the US operations also, which is what is the hope in the coming quarters to continue there.
Okay, so Q2 last year was negative 13 crore. What is the number this year, sir?
EBITDA is minus
5 crore, right?
Minus, correct.
Okay, understood. And the second question is, this is again related to the guidance. I don't want to hold you for this year number. So this is more of a long-term question. I'm trying to get some sense. You are talking about doubling the revenue between FY24 to 27. Now, if I just taking the run rate of the current quarter, we have almost touched the double of FY24 in FY26 itself. Not exactly double, but close to that. So just trying to get some sense that you will still maintaining that this FY24 number will be doubling in FY27, or you think that because of higher traction as compared to what you initially thought that FY27 numbers could be better than FY20? I mean, the initial guidance that you were thinking of.
So what we are thinking is a little bit longer term, because we think, this is very much possible, like you said. Okay. We are looking at doubling from that point in the next 3 years. So the planning is based on the next 3 years already.
Sure. So
from 27 to...
Yeah. But, sir, what I'm trying to get some sense is, I mean, in FY24, we have achieved around 900 crores, 870 crores. Now, my sense is that in FY26 itself, we will be crossing 1,500 crores type of run rate. So you are still like in FY27, you are kind of 1,700, 1,800 crore number that you are looking at, or you were targeting much higher numbers? Because as far as our last discussion is concerned, we were already working on some of the few large projects in railways and all. So that is the some sense I'm trying to get. I'm very much confident that post in next 3 years, you will be again doubling that number. There is no doubt about it. I'm just trying to understand that whether there is any preponement as compared to what you thought initially when you...
We'll all be happy. We'll all be happy what happens earlier, and we strive to do that. But as you know, we're very conservative in our approach. So we still maintain doubling 3 years and doubling again in the next 3 years. And if it comes earlier, all of us are happy. The investors are more happier than what we are. But our internal targets are much higher.
Sure. Understood. And if you can
sorry to interrupt, sir, but I request you to rejoin the queue for follow-up question.
Sure. Thank you so much.
Thank you. The next question is from the line of Himanshu from Krijuna Research and Analysis. Please go ahead.
Hello, sir. I'm audible.
Very much, Himanshu. Please go ahead.
Sir, congratulations on your good numbers. Yeah, my first question is on in your last transcript, you say you are entering into semiconductor equipment manufacturing space, and you buy the industry purpose zero complex box build. So in this quarter, this last 2 quarters, anything manufacturing you start, you can give me a review on equipment.
Sorry, Himanshu. Sorry. Go ahead.
Yeah, you can give me a broad view. Is that you are doing in the semiconductor equipment manufacturing space?
Yeah, we have already started. We have invested quite a bit into that, and we are starting to see the first set of prototypes are going out this quarter, and we'll see high-level production into the next few quarters. So everything is in line, and we believe 1 year plus of work is finally going to pay dividends in the future quarters.
Okay, sir. And my second question is what is the synergy gain on collaboration with ZEPCO Private Limited?
Yes.
What is your synergy gain on collaboration with ZEPCO Private Limited?
Yeah, that's correct. So we have multiple such under gains. It takes time, but what we're seeing is a lot of our customers are starting to engage in design activity in the power side of things, and ZEPCO is one of the leaders in that today. And of course, they're also on a second project working on motors for drones in the India market. That is also progressing well. But collectively, for us, the more important part is the design part, which are customers in the power and clean energy. We have a design partner now, which can take the design part of it, and of course, we are more interested in manufacturing it, and all that is playing out as we plan.
So you start a manufacturing, you planning for this?
No, the design usually takes a year to 18 months at least. Okay, so once it starts now, the manufacturing is a long-term play. It's not something which can happen overnight.
And sir,
sorry to interrupt, sir, but I request you to rejoin the queue.
Rejoin the queue.
Okay, thank you, Himanshu.
Thank you. The next question is from the line of Jalaj from Swan Investments. Please go ahead.
Hi, Jalaj.
Yeah, thanks for the opportunity. Sir, my question was again regards to the manufacturing in the U.S. Facility. So at what scale of operations do we believe that this would reach to let's say, we might reach a break-even operations or a break-even EBITDA level? And could you repeat what was the EBITDA loss in the last year, same time, in the same quarter?
Suresh, you want to answer?
Yeah. So Q1 FY25 was minus 12.7 crores. So that was the number which I was doing in my context. Can you the next part you want to take?
Q2 FY24, 25, what was the number? Q2?
It was minus 5.
So there's a large scale improvement. Yeah, and you will start seeing it play out in the next few quarters, which will be a positive gain for us.
Okay. Some directional scale or and Suresh, specifically, I'm still confused. The 2Q FY25, the losses were minus 5 crores, you're saying?
Approximately around that number, I think should be around you're talking about Q2 FY26 or Q2 FY25?
25.
That's
okay. Q1 FY25 is minus 13. Q2 FY25 is minus 3.9 odd. Yeah.
Okay, so if that is the number, then our EBITDA losses have rather increased in absolute terms, and our revenue has increased by almost from 30 crores to 72 crores, so almost gain of 40 crores, but EBITDA, it has not flown through. So I'm just trying to get my head around that losses have increased in EBITDA terms in the US facility.
So right now, like what we had said earlier, we had spoken about this earlier also, where we're upfronting our investments today in the people as well as in the inventory for the revenues that are yet to flow in. So today you have the cost that is there without the matching revenues which is yet to flow in. Okay, so whatever revenues that you're having in now, these are complex products, Jalaj, which means that you got to train the people for a quarter or slightly more than a quarter to deliver them. So the cost what we are incurring right now, the matching revenues we hope to see in the coming quarters.
Got it. And there's
one thing. See, Jalaj, one thing you have to understand is because you are starting there is why India is doing very well. Because the products are moving here. Okay, so it's not something which is, so they're interrelated rather than you can't look at it separately because we start there and then move it here and all the profitability comes to India after that.
Got it. And then, sir, because of these tariffs, have you seen some...
But I request you to rejoin the queue for follow-up question.
Sure. Thank you. Best of luck.
Thank you. The next question is from the line of Chirag from Keynote Capitals. Please go ahead.
Yeah, thank you for the follow-up. Sir, my question, which I asked about the inflow of order book, I'm still after adding long-term and short-term order book, our quarterly run rate is still around 450-460 crores compared to 400 crores a year back, whereas our revenue has improved from almost 275 crores to almost 380 crores. So just wanted to understand the same thing again. Are we facing any headwinds in garnering more orders at this moment?
Hello. You will have. Can you hear us?
Yes.
Hello.
Yes, sir.
Can you hear? Okay. So in the context, see, when we have a 5-year project, okay, where we know that this amount is given every year. Sometimes certain customers release it on a 12-week rolling. Okay, I may be doing $15 million with the customer. Okay, but order on the book will be only $3 million because he's giving a rolling PO. But you have a contract for 5 years. So we only count the rolling number.
Got it. Fair enough. So it would be incorrect for me to actually compare order book growth and revenue growth together to go align in future also. There can be a possibility of things to happen.
Yeah, that is, you can see it in our growth itself, right? If you look at it 12 months back and what our numbers are today. Right?
So last question from my side. As we have had a JV with Zepco, the collaboration that we have with Zepco, is it fair to assume for me that we are focusing from shifting from being an EMS company to an ESDM company? and focusing more on design to be incorporated on our firm from the client perspective and increasing the part of revenue from design going forward?
So just to clarify, Zepco is a small investment for us. Okay, we have only invested 7 crores. The reason for the investment is we are a manufacturing company, an EMS company. Is that if we can get the design element done, our interest is in the next 10 years of manufacturing, not the first, a crore or two in design. Our interest is once it's designed, can I make this product for the next 10 years? That's a, 200 crore activity, right? So that's why Zepco, and that's our partner, okay, to make that possible for our power and clean energy customers. Did I answer your question? Sure.
Yes, sir. So our focus still for the next 10 years would be on manufacturing side. This is just a small type of collaboration for a certain sector-related design that we are doing so that we can get the orders for the coming years.
The expertise to do that,
Got it. Fair enough, sir. That is from my side. Thank you.
Thank you, Chirag.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Thank you. FY26 has started strong for Avalon with robust revenue growth, solid execution, and continued customer traction across key markets. The upward revision in our revenue growth guidance reflects our confidence in our business outlook. We remain focused on scaling programs, enhancing capabilities, and investing ahead of our growth. Our entry into semiconductor equipment space marks a key step as we expand into more advanced high-potential segments. With a healthy order book, expanding customer engagement, and a flexible global manufacturing model, we are well positioned to sustain momentum through the year and deliver profitable growth. We thank our investors for the continued support and look forward to updating you in the coming quarters. Thank you.
On behalf of Axis Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.